Hi guys. So one of the most important things that you can do when you start any trading program is to reduce your risk, right? Almost invariably, new traders or even intermediate traders are trading position sizes that are far too large for their accounts, right? And I'm not one of those people who says that you should like pile all of your money into your trading account so that you can trade more shares or trade more contracts. That's not the point. If your trading program is working the way that it should, the organic growth, the compounding of your account is going to be more than sufficient to grow your account. You don't need to start with an extraordinarily large number, but you do need to be disciplined with respect to making sure you keep your risk low on a per trade and overall basis, and then be disciplined with respect to employing your trading program. But let me show you what I mean when I say that the first thing that you should do is reduce your risk. Okay, so let's say that you have a setup that looks something like this, right? Your trading program says you're gonna trade with the trend, pretty much always a good thing. And that you are going to take each of these signals as they present, right, until you get into a trend, and then you're going to try to stay with that trend as long as you possibly can, right? And you'll have something on the back end telling you when to get out. After it's run a certain amount, you'll start ratcheting your stop up behind it or something like that. Okay, but let's say that you start out trading with, let's say you have, a 10% per position risk profile, right? Well, meaning that you on each entry you risk 10% of your account, right? So here you risk 10%, and assuming you didn't scale out or do anything like that, goes up, but it comes back down and ultimately stops you out, right? Close, but definitely stops you out. And then it, even if it didn't here, it would have here, right? But you were stopped out, so minus 10%, right? And you don't get us another signal until here, so 10% again, goes up, but remember, now you want the big trend, so goes up, comes back down, stopped out again, you're down 20%, right? Take it here and it's 10%, and of course you get the big runner, and that's very nice, right? And it goes for you, and everybody's getting rich, right? Okay, that's great. So that one would have worked out pretty well. You would have made good money and all that good stuff. But here's the problem, right? And this one would have worked out well also, right? With no pain at all, right? But here's the problem. That same risk profile, right? 10% each time. So 10 minus 10%, minus 10%, minus 10%, you're down 30%, right? Minus 10%, you're down 40%. Not minus 10%, 50, 60, 70, 80, right? 80% of your account just by using a 10% risk profile, right? Gone. You see that? And that's exactly where 80, 90, 95% of traders kill their accounts, right? And then and that's assuming that you're being disciplined and employing it each time. Most people would do something weird like start doubling up and kill their account much sooner. Okay, so a better approach, right, is to have a 1% profile, God forbid, at most a 2% risk profile, right? Because yes, lose 1%, lose 2%, lose 3%, right? Get right here, right? There you go. You're still getting the performance, right? You're still getting the multiple on your account. You're still getting the compounding, right? Right? But when you get over here and you're still employing the same program, right? Then you're looking at down 1, 2, 3, 4, 5, 6, 7, 8, 9. You're down 10% of your account, call it, right? instead of 80%. Does that make sense? I know you guys can't nod for me right here, but I really, that's really, this piece is really important that you guys grasp and understand that, right? The hurry to make quote unquote big money kills more traders' accounts than anything else, right? When you're employing your risk management tactics, you're not using them to make money. You're using them to protect your money, right? That's why reducing your position size is almost always the right way to go, right? Because markets, while they can be traded profitably, they are unpredictable, right? And while you can, with a reasonable degree of certainty, forecast price direction and to some extent movement, you can't do it with any degree of certainty, right? I feel pretty comfortable, right, just looking at my own indicators, that when this pops out here and these start to come out like this, that this thing is going to continue higher for a bit, right? But I have no idea how much further it's going to go, right? And I have no idea which one of these signals, if any, to the upside are going to work, or if something like this is going to happen, right? This uncertainty is what you're protecting yourself against when you are employing risk management tactics and reducing the risk per trade and your overall risk. Okay? Really critical concept. So I hope you guys understand. If you have questions about it, obviously I'm always available. You can reach out, send me an email, you guys are members, send me a text, but really reach out. Let me know, because I want to know that you guys get this, understand it, appreciate the value of it, and most importantly will employ it in your own trading. Okay? That's it. We'll see you at the next video.